We're going to be talking about market stats, rainy day funds. We're going to talk about FIRE. I think we'll talk about that one a lot. And I'll talk about some rate increases, and I'll get my crystal ball out, and we'll start to tell the future. And as always, we are not legal professionals or CPAs, so make sure you guys get these guys on your team. I'm sure Dean and myself can recommend a few good ones, but we're just here for entertainment value. And I'll introduce yourself, Dean. He's the realtor. He's also the CPA. You guys can get him at his email there, and check out his YouTube, which is these videos, and his LinkedIn. But what's been happening in Hawaii?
Yeah, Lane, I guess exciting times from the standpoint of our Oahu stats. So for August, we have a new record high for median single family prices at 810,500. The last record was in, I believe, July of last year, and that was at 795,000. So we have new high. You see it bumping up 3%. On the median condo prices, we also see a slight jump. On the closed sales now, we see both a downtick in the median single family prices at 154, closed at, reduced by going down by 2%, and a little bit bigger of a decrease on the closed sales on the median condo prices at 10%. Probably something to watch. Then again, we look at days on market. We're still in that, we're well under 30 days, well under a month. So this downtick for median single family and no change for median condo prices, to me, is on the Oahu level is not showing us too much. However, the Honolulu Board of Realtors, on their information when they came out, they're saying that they're seeing a more inventory, and we are seeing that more inventory building up slightly over in more on the west side in terms of Ewa and Central Oahu. Yeah.
Oh, that's crazy. $160,000 down payment, and $3,000-$4,000 mortgage, right?
Yeah, it's a challenging time for new buyers, right? So fortunately, we're seeing. I've been talking to various people in the industry, as I mentioned in the past, where they're saying that there's a shift coming, or actually that's come in the last few months. So it doesn't really show so much in the island-wide statistics, but I think we're definitely seeing it, even on the mainland too. I don't know, Lane, how you've been seeing it, but in areas.
I've got a slide in here with the Seattle stuff. So.
Oh, okay. Yeah. Sorry, I don't mean to steal your thunder.
Yeah.
So let's continue with new listings trends. So for the last 3 months, we see June, July, and August. There's been both for single family and condos a little bit of a upswing in July, and then we see it kind of go down drastically in August. But for frame of reference, I put again the August 2017 numbers to show us that that's pretty consistent with previous year in terms of how the cycle is going. That we had a decrease back to these August numbers. So that's more of a cyclical trend than anything else I see. So moving on, Lane, I wanted to bring up a discussion. I had a breakfast this morning with an investor, actually from your Hui, and from the California, and he also is an out-of-state investor like myself and you, investing in residential real estate, smaller single family, and smaller multiplexes in mostly the Midwest, I'd say. So in our discussions, the question came up in terms of how much should we as investors be squirreling away for our rainy day fund. And he had brought up that he had heard from someone say, how's $5,000 per door sound for like a little frame of reference or rule of thumb. And so I thought about it, and my response to him was that it'd be better probably to look at it from a more holistic standpoint. That's how I do it, and from the standpoint of, we have a wife and kids, and we both have jobs, so we're looking at both our investments, our real estate residential investing that we're doing, but also in terms of our balance sheet and income statement in total. So my wife and I are both bringing in cash flow, paying off the expenses, and if one of us were to lose their job, or there's a tornado that is Kansas and takes out some of our properties, we might not have some cash flow. So the approach would be, in my mind, more holistic in terms of overall.
So what do you guys use as a number then? Like, or is it a percentage? What's the idea then?
So honestly, like, I don't use a number, because when it starts to get tight, then that's when I worry. But at this point in time, I think I'm more on the opposite side, where I'm a little bit I have the dry gunpowder to be investing more. So I'm kind of more, I want to be more leveraged than I am. So my problem at this point is too much gunpowder to, I mean, not too much, but like, I want to be investing more. And
Yeah, you don't want to have liquidity just laying around. I call that liquidity anxiety.
Yeah, and exactly. So, but to that point too, I mean, the conversation with the investor, he's a lot younger than myself, and hasn't built up the equity per se, or the cash reserves, and more, at that age, when we're in our 30s, younger 30s, or early late 20s, we're more banking on our income, yeah, our future cash flows from our W-2 income. So with that, that's our financing is based on that, and he's getting into investing. He's been, like, I think for like a year now, but getting into it, getting out of these leveraged deals. And so in my mind, I was telling him, yeah, maybe it's not so much how many dollars a door, but more from that holistic standpoint of viewing your family's income statement and balance sheet. And he's an accountant too, so he kind of talk the same language from that standpoint.
Yeah. Well, I mean, I think when you're starting out, you should be more conservative.
Yep.
Yeah, having a bigger cash reserve. And I guess some of the rules of thumb you hear are like 3 months expenses, or 6 months expenses. I guess the why behind that is like, well, how long is it going to take you to recover if you get fired, right? Like,
exactly.
if you got fired, I mean, if I got fired, I don't know, maybe it'd take me like a couple months to find a job or something like that.
Right.
Yeah.
Know. And so, like, yeah, to your point, I mean, I like that one actually for a starting point, more so than like how many dollars per door, but like, that one is a good one. And it just depends too, right, on the market and in whatever industry you have your job in, because sometimes accounting could be poor, but maybe engineering jobs are hot, and it's easier, the market is easier to get a job.
Right. And I think you told me you don't budget, right? I mean, you've been at this a while, so you guys are kind of at a stage where you've got some savings, and exactly you're more anxious about holding on to more money, not making 1 to 2% doing
and
that.
Yeah, and like, I say that too is because I don't think I spend frivolously. So if there's something we need to buy, then we'll buy it, but we're not gonna go out and buy things that a whole bunch of electronics that we don't need and stuff. So I think we're operating quite lean. We're pretty lean in our spending to begin with, right? So, and we have a big picture idea of what's in our checking accounts, and what's how much we have not tapped out in our HELOC, and what our finance debt servicing that we got to pay every month. So we do have that, I think. But I guess my point is we haven't run real specific spreadsheets.
Yeah. I think it's from a high level. The first question to ask is, where are you in your wealth building? Are you stage 1 of 3, where you're just struggling to even stay afloat month to month, and you're kind of going backwards? If that's the case, then you need to fix that.
Yeah.
Which is harder than said. I mean, I've always been very fortunate to, always be frugal and not to get myself into trouble. But once you're in trouble, it's tough. I recognize that. But, once you've been doing it for a little bit, responsible with your money, and then start to invest it to buy assets, because you don't want that money to be locked up in your equity in your house, not doing anything. You want it to grow.
Right. Yep. And that's the whole point of this scrolling for the rainy day fund, to have it in liquid assets that will help you in times of challenge, when you're
Yeah, I
financially.
mean, I don't have a rainy day fund. I don't really keep money in my checking account. I hide I call it my quote unquote opportunity fund. In I use like life insurance. I use the infinite banking thing, and then
That's right.
I hide money in some pretty liquid funds.
So that's your form though, right? Of rainy day. So you have something that you can tap into.
Right, that's my dry powder in
Yeah,
case.
yeah, yeah, yeah.
Yeah.
And yeah, to your point, it's where everyone is at in terms of their their life cycle or their investing experience. And I guess realizing that too, right? Because you don't want to be lot of the newer guys are, this, they're getting very, not to say caught up, but they're so pumped up with these new ideas that they're finding outside of the typical stock and bond market that they're jumping in. Nothing wrong with that, but it's good that they're, good for them to realize, yeah, that they need a risk management process, I guess, to make sure that they're covering all bases.
Right, right. And every situation is different, and everybody's
Yep,
along different stages. So I think
yep,
that the big thing is having that mentor or that coach and knows your situation
yep,
to advise appropriately.
yep. And that's why this fellow investor is,
So did
he
he
is.
pay or did you pay?
Oh, I paid. It's just the Aloha spirit, man. You know it, right? Like
Well,
you know what? He offered though. He offered, and but I told him, that's fine. I'll pay. It's part of Aloha spirit. And he, fair enough. We went over to Leonard's Bakery right across the street, and he bought me some dessert. So it's all good.
so I have a mentor, and his thing is everywhere he go. I mean, he's sort of made it. He's several million net worth. But his thing is wherever he is, he just pays for everybody
Yeah,
because money is not an issue anymore, and
I
it
like that.
just to get that over with. So that's where you're heading soon.
I like that too, because you get, sometimes it feels uncomfortable, like, oh, who's gonna reach out for a check? So like, to your point, it's just like, yeah, just grab it, and you know it's just paying it forward, because the other investor the time before might have paid for me, so all kinds of evens out, right?
Yeah, yeah. I always think of like always give freely, whether it's a beer or whatever, and see who gives back.
Yeah,
A great way to test people to see
yeah,
how are they a giver or a taker before
yeah.
you work in a deal with them and find out this person's a taker. I'd
Yep,
rather
good
find
test.
out that they don't buy you a beer several times and find
Right,
out
right.
that way.
And the whole abundance mindset, right?
Right, right. You can learn it, but it's yeah, it's hard to change.
Yep, yep, yep. Cool. Great. So I also wanted to bring up this, Who Wants to Be on Fire,
Fire.
and I know this is something you know very well, and I think you just came back from a big event related to fire. Was a FinCon, right?
Yeah, so I used to these people are they call them Financial Independence Retirement Extreme is the acronym.
Oh, extreme. Oh, I thought it was retire early, but okay, okay, retire extreme.
Well,
Got
I guess so. There's different flavors of fire, right? There's
Right, right, right.
there's lean ones, which is the one, this Mr. Money Mustache. He's probably the most infamous character. He started his blog about 10, 15 years ago. He's $1 to $2 million net worth, not too high, but he quit his job, his tech job early, and he rides his bike to get his groceries. Very frugal, sort of a small lifestyle. Yeah, he gives back, but it's kind of, I don't know. I mean, if it was me, I'd kind of grow it bigger and give back bigger in a bigger way. But each to their own, right?
Right, right,
But
right.
he's very extreme in terms of retirement early and living that type of lifestyle where there's other people. I think you're sort of in this. I think you're more of like a fire fat guy.
I like to think that, but I was actually thinking I'm more along the side of, well, in terms of going back and forth and on where I want to be when I, executing. I was thinking I might be in this barista fire software, or where I'd be doing, not to say odd jobs, but just doing some kind of work part time, just things that I want to do for fun or just to keep me active.
Why is it
So
a barista? Like a barista makes coffee, right?
yeah, I guess that's one of the things there. In fact, I think there was one. I'm sure there's more, but there was one podcaster or website where this barista fire thing is. You work part time at Starbucks, and you make whatever 10, 20K a year, and that offsets so much of your entire, I guess, pot of funds that you need to do, right? Because I think some of them are using a formula where they're trying to tap into at most 4% of their big pool of investments. So they're looking for like maybe 2 million, tapping in 4%. But if they're saying if they're working a part-time job like at Starbucks to become barista, that reduces their big chunk of investment that they have to obtain.
Right, right. And a lot of these guys, they like to do that travel hacking thing and live abroad. And one thing that was interesting that you don't realize when you think about it is like they go and they do this lifestyle, and then in middle of the day, 10 a.m., 12 a.m., they realize nobody's around. It's super lonely. So that's why they go get this little job. So they got something to do.
That's a very good point too. I've thought of that too. Taking off a day or two and not just stayed home, and it's kind of cool at the beginning, but it's like it can be lonely. Like they said, like entrepreneurs, right? It's a lonely life because you're not with your employees and being pushed to do the next job on your list, your next level of responsibility, your monthly duties or daily duties. So it can be lonely as an entrepreneur, and I'm assuming that's the same as someone going to try to obtain this FIRE.
Yeah, yeah. I mean, a lot of people. I go on a lot of these podcasts, and they ask me like, "Oh, why are you still working the day job?" And I'm like, "Well, I'm only like 33, and I mean, I've like tried to stay home like how you did a few times, and it's just boring. I feel like I need structure. If not, I just wear the same clothes. I just eat snacks at home, and then
Uh,
and now I work for not like a hardcore private company, so it's like I like the people, and it's kind of fun, I guess, sometimes.
yeah, sometimes it's just finding that balance, right?
Right.
Yeah. Same here. I mean, I've been off and on wanting to reach this point of fire, and then finding out, no, maybe that's just what I want so much because of, like you said, needing that structure. Um, so I'm still on the ledge, I guess, of of pulling the trigger on this new topic.
Yeah, yeah, and it's interesting you bring up that whole barista thing. I think a lot of people that I kind of am around a lot. They're maybe in their late 40s, early 50s. They've been working a long time. There's a lot of scar tissue there. So I think a lot of them are just sick and tired of working for somebody else or working for bad bosses. And
Yeah, I agree. Yeah, and
and
or being jaded by the politics, or yeah, all of that adds up, huh?
right. I mean, they just want out. So they're gonna bust their butt, make 100 grand, 200 grand a year, and just take that next promotion and sort of kill themselves in the short interim to finally just cut bait and retire early.
Yeah.
Um, I like that barista one better.
Yeah. Actually, what I was thinking of too is I was talking to a coworker who's working at the Apple Store, and maybe I didn't realize this, but the Apple Store, like you could be there part time, and I'm not too sure what the requirements are, but you could still possibly get benefits working part time. So maybe that would be like a Apple Store fire. But I also heard it's pretty challenging to get a job doing not it's I guess it's hard to get a job at the Apple Store is what I heard.
Yeah. Well, you know that the health, everybody talks about, oh, I'm just here for the health insurance.
Yeah.
But no, I mean, I saw some pretty good health options out there. Couple providers I was talking to. You ever heard of these like religious affiliated health programs?
No, I haven't.
So they're like a third to half the price of regular insurance if you're like out by yourself. Uh,
Okay.
the thing is like they just won't pay for like, not to get political or anything, but they won't pay for like, abortions or like, like if you went out drinking and driving, they're not going to pay for your health and costs. You know,
Oh, okay.
they're very,
Certain.
they've got moral exclusions in the policy.
Got it. Got it.
So when they
Okay.
stop doing all that BS, and then it's a lot more like less red tape. And that's the red tape is what, like, if you ask any doctor, that's what adds a lot of the costs.
All right.
So you can do it for a lot less if you go through one of these programs. And, I think that's just maybe an excuse
Yeah.
that you
Yeah.
need health insurance.
Yeah. Yeah. To your point, I have heard not about the religious ones, but it sounds like there's like legislation that's kind of at the federal level that's trying to loosen up the standards for these for larger, looser groups to get group insurance health. Yeah, because I think NAR, the National Association of Realtors, they're trying to put one together for realtors because similar situation. The realtors are full-time ones that don't have other medical or we're 1099 commission employees, not employees, but workers. So we need to get our own insurance, that kind of stuff. So there's seems to be some loosening up, and maybe that's similar to this religious ones that you're referring to too. So
Yeah.
hopefully that's makes things better for all the people trying to obtain this fire. Yeah.
Yeah. I mean, I think as a consumer, like if you just follow the normal track, like whether it be a 401k, you're gonna get killed, or your regular health program. I've always preached this, like if you do a little bit of homework yourself and like research this stuff for yourself, you're gonna find something a lot better than
Yep.
the rest.
Yep. I agree. So, yep, that's what I had for my segment, Lane.
All right. Thanks for that. So if you guys don't know me, I have a podcast, Simple Passive Cash Flow, where I talk about money and real estate investing. Dean actually came out to our reialoha.com meetup last month. You guys can join us on Facebook and meetup.
And
And
it was a good one. It was a big event too. They had a lot of guys out there.
yeah, there were like 20 guys. And I got my book here. I got bestseller on Amazon. And if you guys want to win a signed copy of this, I'll mail it to you, or I might even deliver it if you're close. Email us with the subject of book and this episode number. So this episode is number 7. And we'll pick a winner. And just make sure you send us one question that you're looking for us to answer, so we can get some more engagement there. So free stuff. So I'm going to talk about some recent news that's been happening nationally. Is some of the interest rates have been going up, and why is that? Well, there's been this trade war, which I've mentioned on previous episodes. So here's China kind of this is what's happening from China, and then Russia's dumping U.S. debt. China and Russia are not really economic allies of United States, and that's what's leading to these higher interest rates.
So buy your Lihing Muay now, right?
Mm-hmm. But I always say, like, the interest rates, they're going up, but if you're investing in assets, the cap rate should be going up also. Sorry, if you're a homeowner, you don't really get to partake in that. That's why I like real estate investing, not for ownership, but for rental property. But so you were talking a little bit about, some of the softness in the market.
Hmm.
So here's my crystal ball theory right here. I have a theory that Seattle sort of leads the nation. Seattle and San Francisco sort of lead the nation.
Okay.
I've mentioned it before. Some of their rents have been going down. So what happened in the last 5 years is there's just been massive growth in Lake Union area because of Amazon has come in. So this is a lot of high tech jobs, a lot of high net worth people coming in, and you'll have a 1 bedroom for about 1,700 a month. Class A, new luxury property. Kind of something that you would live in if you were 20 years old, Dean, with $100,000 salary coming out of
Okay.
college.
Okay. I can picture it. Hmm.
Yeah, you can picture it. Be good
Yep.
times.
Yep.
So in the last few months, there's been some softness in that. So your $1,700 apartment, you maybe even get for 1,550. Just a little bit too much oversupply in the market. So what's happening is, and then we're tracking the Case-Shiller index here, which is a good index of like the prices of each of the real estate, and they've got it split up in the low tier, middle tier, and high tier. And what they're saying is the low tier homes edged up as the mid and high tier slipped. So that's exactly what we're seeing here. And I believe Hawaii will follow the same suit. And you hear it all the time, right? The condos in Kaka'ako, I mean, it's all sort of just a marketing game, right? I mean,
Yeah.
there's just so many stuff that's available there. They can't really give it away because they don't want to take a big loss, and it's just sort of shameful if anything. But
Oh,
all
you can get
your
like a, you
your
can get like
Mililani stuff, right, is like, man, that's so valuable or so in demand.
so. I don't want to, no sense get into it, but yeah, like I said, even in Milani, we're seeing some softness, but
Yeah. Well,
that's
I would say Milani's what, like mid tier, right? Like even Kapolei's mid tier. I guess the low tier would be like the condos.
right. Yeah, yeah, you could, yeah, especially yeah, Milani. A lot of families coming go for the schools, and yeah, it's a mixture. I think blue, white collar, so it is a mixture. But
Right.
yeah,
So this is kind of data to just when you look at the headlines, the media always kind of twists things a little bit. It's kind of good to kind of dig in and kind of look at it from like the low, middle, and high tier and how things are really going.
cool, like that.
All right, so that brings us to the end. Again, email me for a chance to win that book with any suggestions, questions, or topics. It's Dean's contact, and mine's is Lane at Simple Passive Cash Flow. And we'll see you guys next time.
See ya.